across the Atlantic.
Absolutely, a $1.5 billion cut, or I should say hit to their bottom line. But compare that to like of GM that we had heard last week.
Yep.
Well, the U.S. dollar is under pressure as investors brace for a key Federal Reserve decision this week.
Into a bit more detail on that. They give some 7 reasons.
One tariff, $1.5 billion gone. This isn't China taking a hit. It's Ford Motor Company, an iconic American manufacturer, bleeding out under the weight of President Trump's revived tariff war. Just a few months into Trump's second term, and we're already seeing major corporations crumble under new trade policies. Ford alone says it's facing $1.5 billion in losses due to rising import costs. Meanwhile, the US dollar is sliding fast, shaking investor confidence across the globe. Is this what America first looks like when it's America paying the price? Since April, the Trump administration has imposed a massive 145% tariff on Chinese imports, targeting everything from car parts and consumer electronics to medical devices and pharmaceuticals. The stated goal was to punish China, reward domestic manufacturers, and bring jobs back home. But here's the catch. The modern economy doesn't work like that. American companies rely on global supply chains that can't be realigned overnight. And the truth is, producing goods in the US is significantly more expensive, especially without new subsidies or tax incentives to soften the blow. What we're seeing now isn't economic patriotism, it's economic pressure, and Ford is just the first major victim. Executives confirmed a $1.5 billion loss for the quarter, directly tied to Trump's tariffs, and suspended full-year earnings guidance. In other words, even Ford doesn't know how bad this could get, and they're not alone. General Motors is facing a $5 billion hit and has failed to attract buyers for its new bond offerings. Bloomberg analysts report that credit spreads for auto firms are widening rapidly, indicating investor fear is creeping in. The ripple effect is real. Assembly lines are stalling, suppliers are slashing jobs, and Wall Street is bracing for more. And then there's the dollar. According to Bloomberg's May 6th coverage, the US dollar has experienced its sharpest drop since the COVID-19 pandemic, down more than 8% against the euro and nearly 9% against the Swiss franc in just 3 weeks. Treasury bonds, once the safest asset on earth, are being dumped. Japanese pension funds, South Korean insurers, and even Swedish sovereign investors are quietly pulling out. In Taiwan, central banks are intervening to stabilize currency markets, while pension regulators are urgently reviewing unhedged dollar-denominated assets. The message? Global markets no longer see America as a sure bet. The flight to safety is now heading anywhere but the US. International alarm bells are ringing. Emerging markets like Nigeria, Senegal, and Kenya are now turning to the IMF for emergency funding as dollar liquidity dries up. Trump has cut foreign aid, and without dollars, these countries are gasping for financial air. Meanwhile, the Federal Reserve is caught in the crosshairs. Powell's team is expected to hold rates steady, but that only deepens dollar weakness. If they cut, they'll be accused of caving to Trump's political pressure, something that could shake the very credibility of America's central bank. Trump has already publicly attacked Powell, calling him a coward for not doing enough. Markets fear a politicized Fed, which could trigger long-term instability in both equities and bonds. So where does this leave us? Trump's tariffs are hitting American companies harder than foreign rivals. The US dollar, once the bedrock of the global economy, is now teetering. And the institutions we depend on, like the Fed and IMF, are under strain from political and monetary crossfire. Trump says this is how we win trade wars. But is it still winning when your own economy is bleeding? Now it's your turn. Is Trump's trade strategy bold economic reform or reckless self-sabotage?
UK officials joined President Trump and his team to announce that some kind of trade deal between our two countries is close.
The deal, right? And we started at 10% and we ended at 10%, and the market for America is better.
Just hours after President Trump and Prime Minister Starmer proudly announced their historic trade deal, Jaguar Land Rover quietly suspended its vehicle exports to the US. Yes, on the very same day this so-called economic breakthrough was signed, the UK's largest export sector to the US hit pause. While both leaders hailed the moment as a triumph of fairness and friendship, under the surface, this deal is raising more questions than confidence. So what really happened behind the photo ops and handshakes? Let's break it down.
The US comfortably the largest single country export market, £9 billion.
The UK came to the negotiating table with one clear priority: save the auto industry. According to the UK Department for Business and Trade, the US is Britain's largest export destination for cars, making up 25% of all vehicle exports. That translates to around 100,000 cars a year, worth approximately $9 billion. But in April 2025, Trump imposed a 25% tariff on British auto imports, part of his broader America First tariff strategy aimed at reducing the US trade deficit. Never mind that the US actually runs a trade surplus with the UK, cars got hit anyway. So naturally, this trade deal was seen as a lifeline. The UK hoped to roll back tariffs and protect its core industrial base. But what they got wasn't quite that. Under the final terms, the US agreed to lower its auto tariff from 27.5% to 10%, but only for a quota of 100,000 vehicles, which just so happens to match the number of cars the UK exported to the US last year. In other words, no room for growth, no real advantage, just maintaining the status quo with a slightly less painful tax bill. While Trump called it a massive win, outlets like MSNBC called it staged theatrics. JP Morgan noted the deal would have limited economic impact. And economist Justin Wolfers put it bluntly on CNBC: "If this is a big potato, it's the smallest pea I've ever seen."
And seeing these tariffs come in, I don't want to pay 25% over the odds.
With little relief from Washington, the UK had to scramble at home. Almost immediately after the deal was signed, London relaxed its zero-emission vehicle, ZEV mandates, reduced fines, and exempted boutique car makers like Aston Martin and Bentley, a clear sign of damage control. Meanwhile, on the US side, consumers were already paying more. Ford and Toyota raised prices, while the overall auto market began to cool as Americans braced for more tariff whiplash. According to CNBC, port traffic in Los Angeles dropped 17% in April, indicating that uncertainty around trade policy is actively disrupting supply chains. Here's the real question: was this a true trade breakthrough, or just carefully crafted political theater? As Bloomberg pointed out, the timing was no coincidence. The deal was announced just days before US-China talks in Geneva, giving Trump a media win to parade before heading into more serious negotiations. Yet industry leaders weren't buying it. At the Milken Global Conference, multiple CEOs warned that Trump's tariffs on allies approach sends a dangerous signal. If even the UK, the US's closest ally, can't get tariff relief, who can? In the end, this wasn't a big deal. It was a big dilemma dressed up for prime time. The UK signed to protect its car makers, but the cars aren't moving and the tariffs remain. Trump got his deal headline, but the real economic story still stalled at the port. So, what do you think? Was this trade deal a genuine diplomatic success, or just a well-lit rerun of The Art of the Stage? Drop your thoughts in the comments. And if you found this breakdown helpful, don't forget to like, subscribe, and hit the bell for more smart takes on the Trump 2025 economy. Thanks for watching, and we'll see you in the next video.